Hey, you guys hear me all right? Clear? I got the old school wired headphones today.
Good afternoon. Welcome to Chicago, Future of Finance. I'm Oliver Rennick. It's Tuesday. It's January 13th. Stocks are kind of mixed. We're doing all right. Nothing super exciting in equity world. NASDAQ did pull back a little bit after being higher earlier. The equity market, of course, sitting just near all-time records after we put them in last week. The message ending last week was that stocks look good. Don't fight the trend. 2025 was a great year. It looks like 2026 has the makings of a very good year. The main risk that Steve Sosnick from Interactive Brokers talked about, which I agreed about last week, was that the 26 risk is basically politicization of the Fed. And the video by Powell was quite a statement. I found to be very fair. Obviously, the president has been very aggressive. And my point has been, why fix it if it's not broke? The economy has been stable. Inflation's come down. Look at the chart for stocks. Looks beautiful. So to me, there's some tension in the bond market that remains unresolved. If you look at the 10-year, I think you've got a very interesting setup with this line of 4.2%. I've talked about a lot. That's the reason why I've actually have had yellow on bonds for my risk radar. Last week I flipped Bitcoin yellow from red, looking for cryptos to firm up. We do have cryptos firming up here a little bit. Not a bad little bounce in MicroStrategy, Strategy, or BTC. But generally, that chart still has some proving to do, so yellow for now until we get out of the range, but 100K has looked like a pretty good target for Bitcoin to go back and revisit, and maybe why not 110, where that old trend line now might intersect as potential next resistance. That's if continue firming of the crypto market happens. Back to bonds for a second here, because we will get back to bonds. Pete Najarian's joining me. Jared Dillon's joining me today. Great show coming up. David Trainer's taking us into the closing bell with a forensic look at earnings. Bankerings are coming up as well, and Brent Kochuba's tuning in from, I think, Costa Rica, somewhere tropical, because we can't miss options flows no matter where we are. But here's the last point on the 10-year line and how it intersects with the main news flow over the last, call it 48 hours to a week or so, is that markets are risk on, but the bond market is just stuck here right at 4.2%. I don't think it's a bad thing if yields go over it, but it certainly will be a notable thing. And that's when I might revisit my risk radar for the yellow light on bonds. And by the way, the risk to connect everything here is that if we try to fix things when they're not broke, and there is a politicization of the Fed, and obviously I think there already has been, I don't think there's anything Powell can do, he's getting replaced, but doing so to put someone in who's just going to start slashing rates when the economy is good, that to me is a risk point. So we will revisit that subject later on in the show. Yellow on bonds, a little tension, but nothing showing up in the chart that is calamitous by any means at all, and generally the market does look quite firm. Joining me, Brent Kochuba at SpotGamma. Best place to watch options flows. Brent, first of all, I don't see any geckos in the background, but I know you're somewhere where they reside.
That's right. I'm fortunate enough to be down in Costa Rica. We're doing a little
Wow.
work retreat down here, and so we're having good times. But I am working,
Cool.
so here I am.
Yeah,
Thank you.
right?
It's
Market
90
doesn't quit no
degrees
matter
here
where
and
you are.
sun shining. Yeah.
Yeah, it looks good, man. I was celebrating it being 45 degrees here, but we'll to each of us, we'll take what we're given. Tell me about the market, Brent. What do you, I know when you're on vacation, you do kind of have to be more precise with the way you look at markets. That's at least my experience when I'm on the move. So what are your kind of headlines here?
Yeah, we're still writing our daily notes and we're still in touch here. So the big thing that we were flagging is the equity correlation. And it's funny, Oliver, because if you remember into OPEX, we were talking about the OPEX rally, right? And it seemed like it took a little while for that to finally form. And we ended up getting a nice move, 3-4% rally into the end of the year to finish us at highs. Now we see this bearish setup where equity single stock correlations very low. If you look at the Cboe COR1M, we've been talking a lot about that. That broke below this level that we think is very important. It's 8 on that index. We hit around 7.6 Core 1M. So what that tells us is that through earnings, single stock vols are elevated, but also there was an excessive bullishness, I would say, in the market. And you could see that in these memory names. If you look at like a SanDisk and some of these other names, there's been a consistent kind of rotation, but a bid in the equity space over the last week. And I'll be honest with you, when you had this position, we were looking for like something like a vol spasm, right? If we broke 6,900, that would be risk off. And you see Trump come after Powell and criminal, investigation. Market futures down 50 bips. They ultimately don't care. You get that dip bought. He comes out with the Iran 25% tariffs. That dip gets bought. No big deal. CPI comes out today. We touched 7,000 pre-market in the S&P. And then as soon as we hit that level, all these call sellers come out. SPX index call sellers come out. And we just sort of retraced that move. So at this moment, the bad news is still not creating any type of a significant move, but you see that correlation now starting to shift a little bit higher. The other thing that we see is the VIX.
A little bit, like marginally, right?
Marginally, right? We're off those lows, and this is not a terribly active index, so I don't want to over-index to this little bounce. But if you look at the VIX is now at 16. That's a little bit interesting considering that short-dated implied vols, short-dated implied vols are down around 10-11%. They're very low. And so the fact that VIX is catching a little bit of a bid is interesting to me and suggests that there's some hedging going on. We saw some Feb 2025 call spreads, it looks like, in the VIX trade today at pretty good size, around 75,000. So there is this signal that some hedging is starting to take place. And we seem to be in this little bit of this absorption phase to the upside, right? Where, again, the upside is being absorbed, and I think it's getting harder and harder to squeeze out the incremental upside. So we're kind of in, you still have to stay with the trend, but you really want to be respectful of the risk that is embedded in the market if we break 6,900. There's some charts going around from Nomura and Goldman and the like showing that there's a big short VIX complex that's out there. And so, there's this idea that if there is a vol cover, you could get a pretty substantial vol bounce. But right now, bad news is just being absorbed, and so you have to respect that as a trader, right? The price action says not yet, but if we do break the 6,900 level, I just think you really have to be, prepared for a pretty decent contraction. I think if most people saw the CPI that we got today, you would assume equities would be higher, right? But NASDAQ is lower, big retracement in the S&P and stuff like that. So it's not an Armageddon setup right now, but clearly there is some digestion and some churn rate here, and we need that incremental good news. And to your point before, with all that's happening in Powell, and you have OPEX on Friday, VIX expiration comes the Wednesday after that, and we have FOMC immediately following that, you start to hit this risk window a little bit where the forward guidance could become pretty meaningful, and maybe that leads to a little bit of a correction or just some clearing of some of these overbought signals.
Nice. Like the big picture take there. Nice job. Brent, looking at CPI, as you mentioned, right in line. Also, take out ex-food and energy, a little bit lower than the consensus. To your point, don't see anything wrong with that. To my point earlier, don't fix it if it ain't broke. Feel like we've been moving in the right direction on inflation generally. Back to a few of your key vol charts here. I wanted just to bring up your Core 1M again to look at the dispersion, because last we talked, you were saying if that thing gets below 8, it starts to wave a little bit of a yellow, if not red flag, that markets are kind of getting, complacent to some degree, or just kind of out of whack single stock versus index vol. So I think that's an important point, right? Is that the right interpretation there?
Yeah, that's exactly right. And I think that it's important to know that this is not, hey, we crossed that 8 threshold, so tomorrow's a big sell-off. But I think generally, if you look back last year, it's been a very accurate signal in terms of marking a short-term top. So something in the order of a 2-3% correction over the next, 1 to 2, maybe 3 weeks is a reasonable thing. And again, it's an if-then scenario. If we break 6,900 and the sort of table set for dinner, well, you're probably going to eat, right? The food's coming, be ready to eat. And so at under 6,900, we have these vol positions that can exacerbate downside movement in the S&P. And I think that's the core thing here. It's like oftentimes, there is a risk off level, but there's no punch behind it, right? And in this case, we have a decent, I think, possible punch behind it if we start to lose a little bit of this traction. And again, it's the vol market that is a little bit offsides that needs to possibly sort of correct or reorient itself a little bit.
What if we get big stocks up, vol up, Brent? What if it is that a possibility? Because I feel like I'm getting decent at this option stuff. It was like 10 days ago, I was thinking, we could get vol to creep because you're pointing out there was this mismatch. So one of those scenarios, it doesn't always happen, but sometimes you get vol up, stocks up. But it hasn't been a big stocks up move. It's generally been more VIX climbing the last 10 days. Equity's kind of firming. Could that get more exaggerated?
I think what's happening in the equity space is that the Mag 7s, the big names, have been fairly quiet. Maybe Google is an exception there. And it's been some of the second tier rotation type things. We were talking about IWM last show. You look at, again, the memory names and healthcare. So there are other names that have picked up the baton, but they're much smaller weighting of the various indices, right? And so, there is this interesting situation where you had this rotation and maybe the indices didn't get shifted up as much, right? Because you don't have the NVIDIA, Apple, Microsoft, push or big tailwind there. So, earnings are coming up, and again, I'm not trying to stick a flag that this is an all-time high for the year. I generally see at max 30 days out. So what I'm seeing is call values that are very expensive. So you need incremental upside at relatively high vol to sustain a stock up, vol up move, right? And so that is the problem where when you call values get expensive enough, what happens? People start to sell them, right? Either you sell the calls you own or you short calls because the vol is getting so rich. The second one is we talk about probabilities a lot. If you're buying calls when call skew rank is 90%, it gets harder to have those pay off, right? You need a catalyst. And in the short term, I think a lot of the focus is more on macro, at least in the next 1 to 2 weeks. And then when you start to have some of the Mag 7 earnings into the end of January, February, maybe those earnings are great and that sort of respikes or restokes the coals a little bit here. But in the very short term, we do have this sort of stressed overbought signal. And again, I don't know what to expect out of FOMC. Obviously the Powell situation is very interesting and unique. How do they respond with this lower CPI, et cetera? Oliver, I was just checking mortgage rates before he popped on. 30 years at a major low. We're only at 6% on 30-year mortgages because of Trump's kind of QE there, right? So there's a lot of interesting macro signals that are churning right here, and a lot to read, I think, over the next week or two, which just means to me you should anticipate a little bit more volatility, right? Because there's some unexpected signals out there, and so you want to price in a little more volatility. And I think that's what the VIX is telling us. Because 1 month realized vol is still 9, right? So the stock up, vol up thing is not really chiming with that because, yes, we're at all-time highs, but we were basically unchanged over the last 5 to 10 days if you look at it, right? We're still at 69.50 right now.
The story has been more about the between VIX and S&P. I think technically if you want to go 10 days, the story is more about the VIX is one way to kind of put all that, right? I mean, the trend line, I'm looking at it for VIX is a little bit more kind of obvious to some degree than for the SPX, which is certainly at the higher end, looks fine.
Yep.
I guess they both have been trending, but stocks aren't blowing out yet by any means. Now, maybe if we get through the 7K, which kind of comes back to your main levels and stuff, then different story.
Yeah. And what we saw today on the move to 7,000 was 0 DT calls in the SPX were sold hard, and some longer dated puts did get purchased. And so it almost looked like a little bit of a weird calendar spread risk reversal where the short dated calls are being sold at 7,000, the 0 DTs, and then some longer dated puts are being added. And whether that's a hedge into Powell and VIX expiration and some of these other things, that can make sense. Again, there's some of the speculative positioning, CFTC data showing big spec shorts in the VIX complex or vol complex. So there is some signs again here that vol just needs to sort of be reset a little bit, and that could be just, again, a healthy correction. And I actually think a correction from here is helpful ultimately because it energizes vol a little bit, right? And that way we have more energy to maybe break through, say, 7,000, right?
Yeah,
like a slingshot, you kind of
like
pull it back.
You pull back, and basically what happens, there's some mechanics to it. There's real physics to it, right? So
Yes.
people there waiting to catch, right? They got their glove out, all right?
Yep.
Market comes down, boom. Then what do I do with the ball, right? Now
Yeah.
now that potential energy has turned into kinetic. I'm ready to throw it back. Like it's a real thing when people, if they are short, which if they're starting to build up a little bit, kind of keeping that vol pinned, then we go down, they take it off, they're happy, time to get back into the market. So it can be a nice little slingshot.
And volatility risk premium is a massive asset class, right? People want to sell vol. It performs very well if you look at the Sharpe ratio of just selling puts over time, right? Obviously, if you're holding short puts in April of 2024, you're game over for you. But generally speaking, people love stepping up to sell vol. So if you get a little bit of that vol premium going, then they want to sell that. Right now, there's no, there is some vol premium, I would say, because the VIX is at 16 versus 1 month realized vol for the S&P is at 9. However, we do have some of these catalysts coming up, and the short-dated vol holds very little premium. We're talking about 0 to 5 days to expiration. And so, again, in your chart here, you can see there's some mild intraday support there at 69.40. Okay. If you zoom out a little bit, we're still watching this 6,900 level, right? And those are intraday levels. Those are 0 DT traders that are coming in. They come in and sell options, right? And that's what they do. They sell puts and they sell calls, a la the Captain Condor fame. And that tends to work very well when there's not a specific catalyst. Now tomorrow we have the possible Supreme Court ruling. That's one short-dated piece of data people are watching. Then obviously retail sales. So there's that normal kind of monthly cyclical data that's coming out. That's generally not commanding much of a risk premium. I think again the big thing that's going to come up here is going to be Powell and sort of the forward guidance out of that meeting, particularly in light again of lower CPI data, decent jobs data. Who knows what goes on with this criminal investigation and how, quote unquote, the Fed responds. That's above my pay grade to sort of wade through that. But there are these weird catalysts like roaming about, right? I was surprised because, if you remember in October, Trump tweeted tariffs and that led to a 3% drawdown, right, in a day. And the market ignored it here. And so I think that is important. Like, we're not positioned for that risk-off move yet. So wait for the shot across the bow, I think, and that'll be the signal maybe they can add to some shorts. But for the moment, you have to respect the dip buying. If you want to look at something bullish, Oliver, we talked about silver ad nauseum.
Oh, yeah. Where should I
but
go
massive silver options volume today, 2.4 million. Huge.
There we go, I got it. 2.4 million SLV.
And if you click on that and you just look at puts versus calls, it's all calls, right? These are expensive calls that people are buying here or trading now. Obviously, there's some call selling going on, but you can see that premium being traded there. Just those pie charts are showing
1.5 million calls.
And that volume is massive. I mean, it's just incredible.
Yeah,
so there's a ton happening there.
So that's a big bullish spread there.
Now we're tracking, if you look at the premiums for the metals, if you look at like APMEX, for example, silver Eagles, which are trading at probably $50 a couple of months ago, they just hit 100, and that's with silver on 80. So that physical premium is really getting big, and it's pretty fascinating to watch. So there's clearly some major demand persisting here into the face of these very elevated implied vols, and so that sector or that story is still has a huge tailwind, and you can see that call activity is just at 2.4 million contracts. It's hard to stress how amazing this is. I think this could be the highest SLV options volume ever, and that ETF I think is now getting big enough to start wagging the commodity dog, so to speak. Which I think is really
they're changing how they're trading it, how they're offering margins on it based on dollar versus swing, because it's now literally being managed like Bitcoin by the exchanges because it's so wild. It'll be interesting to see how that will transfer over into gold or lack thereof, because today Bitcoin is up. Stocks really are flat, but silver's out there too. So silver to me, and gold, by the way, is off a tad. So I think I'm feeling somewhat validated also kind of in my description over the last couple of weeks is Bitcoin being like or silver being the Bitcoin version of gold, basically. It's a little crazier, just in terms of beta, in terms of swinginess, in terms of risk, and it has nothing to do with them as assets or anything like that. So I love the details on the call buying skew in there, Brent. Great stuff. Appreciate you coming to us from Costa Rica, man.
Thank you, Pure Vida.
Yeah, there you go. I love it. Pure life, good life. Brent Kochuba, SpotGamma, great stuff. Thanks as always, sir. And I think I heard him say something about Eagle in there, which made me think of Pete Najarian, who's jumping in on the Zoom for us. We got to hit the. We're going to hit a lot here, Pete. How are you, sir? I know that you're not in quite as warm a place, right? You're still in the Midwest, celebrating with us here in Chicago after the Big Bears win.
Mm-hmm. Absolutely. I'll tell you what. I'm actually in Minnesota right now, but I will tell you.
That's close enough. That's close
enough,
enough, man.
It's very close. It's easy. You know, I can get there in just a few hours if I'm driving, and I can get there in an hour.
You heard the rumble from the stadium.
Absolutely. Let me tell you something. It's beautiful here today because we finally got a little bit of sun and we got some 40-degree temperatures, but that's going to end actually at the end of today. So.
I heard. I was celebrating that too over here. Yeah, no, that was the lead on my show today. It was 45 degrees in Chicago.
I am excited about those Bears, though. I'm excited for them. That being said, I'm not sure that they're going to get to where everybody wants them to get, but that's okay. I mean, I think that in 1 year, this coach has done a magnificent job. I mean, absolutely unbelievable job. He changed everything about the culture with the Bears, and obviously he's been able to get the quarterback to be able to do things that the previous coach was not able to do. And Caleb's really stepped it up. So a lot of fun watching this as it plays out.
We've been watching the Kalshi numbers. I'm going to pull them up here, Pete, which they haven't budged much, obviously, for, Bears taking it to the house, going all the way. But, obviously the number of teams narrowing here. And again, because I don't know any of the details like you do of, who's strong against who and why there's such a big skew for Seattle or LA right now. But the point is that when I just see a set of 7 teams, okay, 7 data points I can choose from, and one of them, really several of them here. I mean, 6% for Chicago right now. Denver's down to 9. San Francisco's at 5. The fact that one of these 7 or whatever I said has to go to 100 in less than a month, to me, makes a very fun playing field to gamble, basically.
Absolutely. It absolutely does. Let me tell you,
there's just so much randomness that can happen.
Yes, absolutely. Footballs bounce a lot differently than a perfectly round ball, right? I mean, so that's a big part of this whole thing. But I will say this, if there's one team that's been absolutely rolling, there's really 2. There's one in the NFC, one in the AFC. If you take a look at the New England Patriots, unbelievable the job that they've done out there. And Drake May as a quarterback has really stepped it up. They've done an amazing job this year. They played both sides of the ball extremely well. But I'll tell you what, the Seattle Seahawks are there for the right reason, in my opinion. I mean, those guys... The offense has been incredible. They're a scoring machine. The defense is the number one protecting against those points as well. And it's just everywhere you look on that team, you see something that really does stand out. And all you got to do is take a look at the fact that, they've won 11 of the last 12 games that they've played. So they're on a roll. They really are playing well. I've got friends on that staff who are coaching both on the offensive side and the defensive side. And I can tell you, they're really excited about what they've got, and they stole Sam Darnold from the Vikings, who somehow decided to get rid of him, which was a huge mistake, and they let him go out there to Seattle to have one of the best years he's ever had, the best year he's had as a quarterback.
The fact that, by the way, this is the time here is closing pretty quickly also makes the math behind this fun, too, because if for whatever reason you think you've got any nugget or smart take on it, Pete, then even if it's Seattle or LA too, right? You're going to make 75 on 25. Mm-hmm. So obviously you adjust in your portfolio based on your risk tolerance, and I consider it a gamble. That's why this block is the gamble. But this is the funnest time of year to make these type of plays because it's like almost to the 0-day option version.
Yeah, no, it's fantastic, and it gives you all these great opportunities. I mean, Kalshi's really pretty special, and I love what you're doing and bringing this into this whole thing. And I got to tell you something. Just looking around and knowing that Seattle is in the position they are, and you talked about the Rams for a second, that quarterback's been absolutely unbelievable this year, right? I mean, MVP-type numbers, and who knows? He's also 38 years old. So just think about that for a moment. He did so well when he was at Detroit, but he got out there to LA. He's done a great job. They have a great defense. But New England, I can't emphasize enough. I think it's going to be a Seattle-New England game because both of them have been so dominant this year that I think it's almost a layup. Now, nothing is a layup, but that's why I said almost a layup. I think both of those two teams have an incredible opportunity in front of them. But don't look past this one. I think over the next jump, I would be very, very closely watching the Houston Texans because their defense is absolutely swarming, and they do a magnificent job as well. They are so good on that side of the ball that the offensive side doesn't have to be as good as some of those other teams as long as the defense plays the way they did. And that's Aaron Rodgers. If he does retire, his last throw was an interception for a touchdown. So I'm thinking he might come back.
All right. I love it. So look, obviously you've got your own reasons to think, your own expertise, and I'm sure that the betting odds and the makers know why these teams are trading 25-20, but here's the bottom line. There's 8 teams left, okay? 1 divided by 8 is 12.5%. I'm happy enough on my gamble to buy anyone under 12.5%. You know, that's the way my mind is, Pete, because there's so much randomness that could happen. I hate to say it, it's football. It's the most dangerous. It's violent injuries. I hope there's nothing like that, but it's just the randomness of it. I'll happily take the other side of under random, 12.5%, especially if it's my hometown team.
I'll tell you who I also like, and I know you're talking about the Bears. I think the Bears at some point are going to stumble, but San Francisco, outside of the fact that they have, I think, 6 or 7 players on IR on the defensive side for San Francisco, they have to outscore people. But I'll tell you what, they still are playing at an elite level, and I like what San Francisco's been able to do, the fact that they've got all these injuries on the defensive side. They've got Bosa out. They've got the linebackers out. They've got safeties out. I mean, they are really struggling on the defensive side. But Purdy in the offense is doing a magnificent job as well. And you know, it's fun to watch that team, I think, because of the fact that I think McCaffrey might be the best player in the entire NFL. I know he's not going to be the MVP because of the position he's in. But the way that kid can run, the way he can block.
He's a beast. I have seen him.
He's unreal. He's unreal.
Yeah, he's a monster. Reminds me of my brother, who was probably would have been on one of these betting lists for us if he had my height, or your height, Pete. But he was just a little short for a white guy. Hey, before we move out of football, let's run the gamble real quick. Because we do have some serious stuff to talk about as well. All right, while that moves over, here's what else I got. Number of rate cuts, Pete. That's an important one, too. All the Fed drama. You know, I think that right now the market is telling us that video didn't really make a difference. You know, we're still looking at basically 2 to 3 cuts as having the same odds for this year.
Yeah, I mean, when you look at it, that makes a lot of sense. And the only reason I'd move over towards 3 cuts is the fact that if things go the way the president would like them to go, I think he would have, whether or not he's supposed to or not, he's going to have that kind of influence, I think. And I think that it's more than 2 for sure, and I think 3 makes the most sense. So I'm going to go with the 3 cuts. Now, as of right now, we're going to pause when we get into this January meeting, but as we get a little bit deeper into the year, I think that there's plenty of room there for the cuts that we would expect. So I'm going to go with 3.
Okay. I think 2 to 3, even 4 doesn't make too big of a difference. I think if it were clear we were getting 4, there's some convexity to this trade where bonds might start to blow out. But I feel that that kind of big move in bonds won't happen unless we see 4 cuts or above, let's say go to where the 2 or 3 cuts are right now. If 4 cuts start to get priced, I think that maybe we start to say this is a little bit aggressive without any signs of real drawdown. Are we going to stoke inflation again? Because, let's say it, Trump likes low rates. He's making a political move, basically. But I think it's good that so far the market is saying don't worry about that.
Yeah, no, you're exactly right. I mean, well, just a great example of that is when you look at the VIX, you know, I heard you guys talking about the VIX. When you look at the VIX, let's be honest, for the last month, we've basically been within a very tight range. And Oliver, when you're looking at somewhere between 14 and 15 and a half, and I realize today we're back over 16 again, but it just seems like we haven't been able to break out to the upside off of that. But you know what? We are moving at a pretty decent clip today, and obviously we're bouncing around near that 16 VIX. Can it go higher? It absolutely could. Could it get up to 20? Sure. Would I be scared at 20? No. But if it started to completely move to 25 to 30 to somewhere in that range, that's where people are going to get a little bit nervous. And we haven't seen as much on the volatility index in terms of those huge buyers, that gentleman that we always refer to as 50 Cent, because basically those huge numbers that he puts up there oftentimes are surrounded. If it's a spread, it's basically a 50 cent spread. So the nickname for that particular trader at 50 Cent makes all the sense in the world. But is that going to happen? You know what? It's going to be interesting to watch to see. We did see some volatility getting bought today, but that was in that short-term VXX. Totally different animal. So I think that we're still waiting to see, is there an appetite for the VIX itself? And I think that's something, when we see that again, it might be interesting, and I think everybody ought to pay attention.
A good follow-up to the discussion with Brent about, if we get through 7,000, do you get that vol crush even further, or do we see this as the first day of something maybe that might become a period of softness and VIX really starts to move? But to your point, until you get a real pronounced move in volatility, it seems like it's been steady stairs up and to the right. I pulled up Kalshi odds for S&P close end of 2026. The highest odds right now, 12%. Call for about a 600-point move, Pete. So, less than 10%, about the average, 8%, something like that?
Yeah. Well, when you look at it and you go back in time, 76% is the most common move to the, that's the accuracy of it going up 10%. So I think when you asked me the question earlier, I'm sitting there looking at it going, you know what? 10% isn't that big of a stretch to say, yes, it could be 10%. Could it be even higher? Yeah, it probably could. But I like what we're seeing there. And if you go through time and you see that 76% of the time we are going up somewhere within that range, 10 to 20%, I think that's a fairly decent layup, and I like it. And I also like the fact that I think there are some great triggers out there that could be something that really does push this market to the upside. That could be still technology, it could be financials, and it could be energy, or all three. So I do think that there is plenty of room for a move like that this year. It should be pretty interesting to see how it all plays out. But I got to tell you something. It's right now, when you look at the financials, they are cheaper in terms of the growth rate. They are cheaper and they're lower PE than the S&P 500. So if
this
you piece
is a fun
that
one to get
together,
into.
I'm sorry.
This is a fun one to get into today because they are getting hit right now.
Yeah.
A little bit of a pullback. I'm going to pull up XLF here, Pete, because I know that you've been watching these banks and you've been on that. Goldman Sachs. Big move. Hans Albrecht, who's on the show, also was plugged into that. So I think that the bank coverage, while we've been on it, we could probably be on it even more because they had a really nice move. Is this a buying opportunity?
I think it will be, but I think we want to get through a little bit deeper of those earnings themselves. And obviously this week is earnings week, right? I mean, we've got Citi, we got Wells Fargo, we got Goldman Sachs and Morgan Stanley still all in front
baby.
Thursday. So it's going to be a busy week of finances and financials, and it's going to be interesting. I think these investment banks, when I looked at the numbers, by the way, record revenue for JP Morgan, and yet and they beat on the earnings, they beat on the revenue, but people were a little bit more. They were more hung up on it, I think, on some of the investment banking side. Well, maybe it just slowed down towards the end of the year, which is, I think, what part of the reason why it turned out the way it has. But I look at that and I see equity trading up 40%, Oliver. That's a pretty monstrous number. I don't think we are really in that bad a shape on the financials. I think people are looking for an excuse to maybe take some off because of the fact that, take a look at every one of those charts that you're putting up, whether it's Goldman or Morgan or JP Morgan or Citi.
Yeah, I'm on JP Morgan. It crossed through its 50-day moving average, so it usually doesn't stay down there for too long.
No, and the bottom left to the upper right, as a good man used to always say about the financial world.
That's a trend.
And that's what you're looking at. Each one of these, when you pull it up, I mean, it's absolutely extraordinary, that move that they had last year. I think that move continues, and I still think IPOs are going to be big. I think M&A is going to continue to be very big and a lot of roll-ups and so forth. So I'm not overly worried about, and I think some of the pullbacks, if it gets back down to some of these certain levels, I think that would be a great buying opportunity.
All right. Goldman, if it goes the way JP Morgan went and it gets down to its 50-day moving average or below, that would mean 877. for Goldman Sachs. For some context right now, it's trading at 940. So it sounds like you're ready to scoop those up on dips. The other one I just want to bring up since we're talking banks is the regionals, Pete, KRE. Any interest in taking a combined financial plus small cap play all in one? Go for KRE. What do you think? You trading that? You dabble in that at all?
Yeah, once in a while, and I haven't recently, but not too long ago, I guess we did see some option buying in there, very sizable option buying in there. You know, I tend not to be as much of an ETF trader. I like to be far more onto, if it's possible, into individual names. But so there are certain regionals, sure, I like them, but we haven't seen the kind of option buying in specific names, but we've certainly seen it in the KRE. So something that I always keep in the back of my mind as I'm looking and I'm watching things play, you know, as they go through the day. I still think that there are great opportunities out there in some of those names, just not all of them. So I'd go to the individual names. Plus, they move a lot quicker, oftentimes better beta, in other words, than you would find when you look at some of those ETFs like KRE.
Very fair. All right, Pete, I got one more for you, and this one's for the culture crowd from Kyle Shee. But we, you know, everything's fair game here. Oscar for Best Actor. You movie guy, Pete? Because apparently word is that what's it called? Marty. What's his ping pong movie, Matt? What? Which one? Marty Supreme. Yeah, Marty Supreme. I don't know, Pete. I don't know if I'm in on the ping pong stuff, but I feel I got to see it because I did see one battle after another. And Leo only at 15% right now for Oscar Best Actor means Chalamet damn well must have blown it out of the park.
Yeah, I think Chalamet's probably got it. I mean, he's at 77%, I think, for the right reasons. I mean, last night I happened to be flipping around and I'm looking at Golden Globes.
He's got the swag for sure. The guy is swagged just to the max.
He's got the swag. You know, he's a young guy. He's got all these things running for him. And, you know, Leonardo's staying pretty young, too. I don't know if you saw who he's married to, but his wife's a pretty young
Always, yeah. He's a vampire. I saw them exchanging a nice embrace. You know who DiCaprio really reminds me now is he looks like Marlon Brando. And the way he holds himself, too, you know. I feel like he is really... I mean, hey, he killed it in one battle after another as well. So I don't even know who else is on there, but... I guess Chalamet, you got Kylie Jenner on your arms. Things start to go your way.
Yeah, that's not so bad. That's not
more
a bad
or
deal.
less. Pete, fun chat. Appreciate it, sir. Good stuff. Pete Najarian, always fun.
Thank you. Appreciate it, Oliver. See you, man.
You got it, sir. Pete Najarian, Market Rebellion. All right, we got a 2-minute break here. The buffer break from Innovator. New ticker, by the way, for the month of January. Then the great Jared Dillian joins me after this from Daily Dirtnap. Always got a hot, fun take. We'll be right back.
With increased volatility, investors are bracing for large market moves, both up and down. Will the market rebound 30%, or will we see a 30% drop? At the end of the day, uncertainty remains a constant. Innovator's floor ETFs are designed for volatile markets. They aim to position portfolios for market moves regardless of direction or magnitude. They are intended as a core equity solution, providing exposure to U.S. equities with built-in downside protection, seeking to deliver more than 70% of the upside and targeting a max loss of 8 to 12% annually. With specified levels of sought-after protection and upside participation, we believe the floor ETFs offer an evergreen strategy designed to allow investors to remain invested regardless of the market's direction.
There are two things about Chicago finance you can't get anywhere else. The first is kind of hard to miss. Everyone's trading options. Cboe is on a 5-year growth streak making billions, and its goddess of grain sits atop the final pit of open outcry. And that's what it's all about. The chance to fend for yourself. A fortress for the self-made trader, and the only still standing in America. The second thing you may not know, but it's worth trillions. Chicago is the only major city in America that's home to 2 of the top 10 registered investment advisors, according to Barron's. That means a steady river of passive money and fixed income pouring into the city. If you think you can beat the market, this is where you do it. If you've got value, price will discover you here in Chicago, the future of finance. Join me, Oliver Rennick, from Cboe, Tuesday, Wednesday, Thursday, into the closing bell, live from... Welcome back to Chicago Future of Finance. It's January 13th, it's 2:38 p.m., and stocks are a little bit off on the session. We're at 69.44 and the index fixed 16.5, but otherwise a pretty quiet session that has MicroStrategy coming back to life, Michael Saylor's Bitcoin experiment, as well as crypto itself. Could it possibly be because there's politicization? God, I cannot say that word, Jared. How's it going, sir?
Good, how are you?
I'm pretty good. Good to see you again. Thanks for coming back on.
Yep.
So the Fed video that Powell uploaded, I think, is the most interesting thing that's happened in the relationship between the Fed and the president, obviously, maybe to date. Markets don't seem to really care so much. Bonds are quiet. Stocks are pretty quiet. Is the Bitcoin thing related to it at all? Because gold's down today.
Yeah, so first of all, when Powell posted that video on Sunday, stocks were down about 50 basis points overnight. And then they crawled back to lunch the next day and we're down about 40 basis points-ish today, something like that. I don't think there's really, aside from the grand jury investigation, I don't think there's a lot of new news. I mean, Powell and Trump have a lot of history going back to Trump's first term when Trump was relentlessly beating on him on Twitter for not lowering rates.
Yeah. By the way, in case, I feel like this has to be said every time, it's his pick.
What is Trump's pick?
Powell.
No, I think Obama picked Powell on the board of governors. And so Trump picked Powell to be chairman. Trump picked Powell to be chairman, but Obama put him on the board of governors originally. Anyway,
still he put him up as chair, and buyer's remorse.
Well,
man,
the irony is his choices were Kevin Warsh, Jerome Powell, and John Taylor. And the reason they picked Powell is because they thought he would be the easiest to push around. And that has turned out to
totally
be the
right.
exact opposite, right?
Yeah.
And Powell and Trump hate each other. Trump hates Powell. I know some people who work at the Fed. I know some people in D.C. This is personal. Trump hates his guts. So none of this is really surprising. So.
Yeah. Well, because they think that the timing of certain rate cuts was because of, not just during, but because of the presidential election, all that, which is just like, who knows? Who knows if it was or not? I can't get into Powell's mind. I don't know. I don't think they were. I think that, like, you look at the trajectory of everything, that some of the timing by Powell could have been better. So could it for all of us. Anybody who's ever put on a trade in their life, could your timing have been better? Yes. But otherwise, inflation's come down. CPI report today in line. Bond market is quiet. Stocks are at all-time highs. Unless it's for crypto, okay. But like, it's just pure vendetta at this point, it feels like.
Yeah, it's pure vendetta. And also, look, I'm not a legal expert, but I don't think this is going to go anywhere. I think, like the Comey investigation or Letitia James, these got thrown out. I think this is going to get thrown out. I think there's zero chance that Powell is going to end up in handcuffs. Let's put it that way. So,
let's
and
hope
by the
not,
way,
because I have a high tolerance for political turmoil, because I think that it's just, I don't like to get involved in it. But boy, if it gets the Fed chair, then we all, that's.
Yeah,
really
and
hope not.
the other thing is that this is going to backfire on Trump, because now the Fed is, like, the probability of rate cuts has basically disappeared. In fact, we might even be looking at rate hikes.
Wow,
I've seen some
totally
articles over the
called
last
him a
couple of
jerk.
days.
That's crazy. I'm not trying to fan the flame here, but I just called him a jerk.
And also he increased the probability that Trump is going to, not Trump, but Powell is going to stay on the board of governors after he's done his term as chairman. So, Totally backfired.
I mean, look, again, I think I can proudly say over the last decade I've spent some of the least amount of time analyzing politics compared to any of my peers. And so maybe I get the pass to say that, like, this is where I put my foot down, is like, because if you just go with the objectivity, stocks are at highs. Like, what do you want? What more do you want? Stocks are at highs. Economy's doing fine. We leapfrogged across everyone post-COVID. I got a chart somewhere. Let me see if I can pull that up. You know, it's like, what more can we want? And my view now is, Jared, if you didn't start cutting rates for no reason, that's when you get problems.
Yes. Yeah, I don't think we're going to get any more rate cuts anytime soon, at least not until May. So, and by the way, you know, we stopped talking about this. Lisa Cook is still on the Fed. If you remember when Bill Pulte, like, I guess, dragged up her mortgage information and said that she got, I think she declared her vacation homes as her primary residence, accused her of mortgage fraud. She's still on the Fed. They haven't gotten rid of her yet. So,
yeah. What is the market interpretation, Jared? Because I look at bonds at 10-year 4.2%, and it basically tells us that we might be having fun in this drama, this comedy drama, but the market doesn't care. That chart to me for bonds sitting at 10-year at 4.2, what say you?
Yeah, I mean, the thing to understand about bonds right now is that volatility has been totally sucked out of the market, and I'm not really sure why. You know, but we had CPI today, and, you know, tens have moved a couple of basis points. You know, we've had, like, no volatility at all. Last I looked, like, tens are up like 3+, like really nothing special. Like, you know, you see that tight little range on the chart. Like, if you look at the move index of fixed income volatility is at all-time lows. And the bond market just isn't moving. And what else isn't moving is the dollar. The FX markets have absolutely slowed to a crawl. The dollar has been in a tight range over the last 8 months. So in macro land, there really hasn't been a lot to do aside from just be long stocks and gold, you know?
Absolutely. Good transition to the point here. What is your kind of strongest conviction view right now? If we view these, you know, I was reading the statement by Bill Gates that said he thinks, you know, we're on the precipice of like this awful period in human history. If you ascribe to any of that negativity that's out there, is gold really the way to do it?
It really is. I mean, it's the perfect trade for that. So you're referencing something I retweeted the other day. Bill Gates said that within the next 5 years, we could be entering another dark ages.
That's right.
And the dark ages lasted about 300 years, from about the year 700 to 1000. I mean, here's the thing about human progress. Human progress is 3 steps forward and 2 steps back, right? All the time. And, you know, just from a stock market standpoint, aside from a blip in the pandemic, we have had a bull market since 2009.
Yeah.
We have had a 17-year bull market. So when I see things like capping credit card interest rates or telling defense companies that they can't pay dividends or do buybacks, I mean, this is economic unreason, right? Like, we are going backwards economically. We are adopting some of the socialist policies that have driven other countries to near bankruptcy in recent years. And the stock market just keeps going higher. So Bill Gates, I don't think Bill Gates is a pessimist. I'm not really a pessimist. But at some point in history, we're going to have our 2 steps back. And there's trades for that.
I hear that. I mean, look, up and to the right does mean, you know, volatility along the way. My kind of simple version is that the S&P is very much kind of illustrative of the human experience up and to the right, but with volatility dips, chasms along the way. I will say that the kind of counterpoint that I would offer, Bill Gates also does make in his statement, which is that AI is kind of the exception. Obviously, there's debate about what impact that's going to have, but I just view it as technology, and technology has a perfect track record over time to improve things for us. The other thing I was just going to point out is that when you look at, not that one, there we go. If you look at us versus the rest of the world since COVID, I mean, we're the ones above trend. we're the ones who have leapfrog further. And to me, that gives, I think, confidence too. What do you think about this chart, Jared?
Yeah, that's a pretty interesting chart. And actually, going back to 2000, that's apropos because that's when I started working in the business. Going back further, the 1920s were a time of a stock market boom, but it was also a time of incredible technological progress, kind of like we are experiencing today. People had washing machines for the first time. They had dishwashers for the first time. They had appliances. They had TVs. They didn't have TVs. They had cars. They did not have TVs at that point. So, but it was a period of massive technological progress. And then after 1929, somebody just wrote a book about 1929. Not only did the stock market go down 89%, but that technological progress basically stopped for 15 years. That was the dark ages. We were frozen in history. And it's, I wouldn't take it as a given that technological progress always goes up and to the right.
Sure,
that can also go sideways too.
Yeah, so. I hear that. Fair point. And if it ever goes sideways in a parabolic way, it could be bad news, if you know what I mean. Jared, thank you. Always appreciate your take.
Thank you. Thanks a lot.
Fun stuff. Jared Dillian, always a good take there. Good context for us on some news articles too. We're closing it out by talking earnings when we come back. We got a 2-minute buffer break from Innovator, and then David Traynor joins me from New Constructs. He designed an index upon which an ETF was built and had a killer year last year. We'll be right back. 2 minutes.
With increased volatility, investors are bracing for large market moves, both up and down. Will the market rebound 30%, or will we see a 30% drop? At the end of the day, uncertainty remains a constant. Innovator's floor ETFs are designed for volatile markets. They aim to position portfolios for market moves regardless of direction or magnitude. They are intended as a core equity solution, providing exposure to U.S. equities with built-in downside protection, seeking to deliver more than 70% of the upside and targeting a max loss of 8 to 12% annually. With specified levels of sought-after protection and upside participation, we believe the floor ETFs offer an evergreen strategy designed to allow investors to remain invested regardless of the market's direction.
Welcome back to Chicago Future of Finance. I'm Oliver Rennick. We got 9 minutes until the bell. We've got earnings also over the next couple days here. It's going to get pretty busy with banks. Let's take a forensic deep dive into the world of earnings with Mr. David Traynor at New Constructs, longtime source of mine, probably the most well-informed on earnings and fundamentals. David, good to see you.
Great to be with you, Oliver. Thank you.
Absolutely. Let's first talk about earnings, and then I want to talk a little bit about the index you made that had an incredible performance last year. What's top of your list to watch over the coming weeks for U.S. stocks?
Yeah, we just published a report on the stocks that we think are most likely to beat. Again, this is based on our proprietary measure of core earnings. We'll talk more about how well that works in a second. But on our list of stocks to beat, top of that list is Decker Outdoors. Number 2 is Clorox, and number 3 is Molina Healthcare. Those are all companies that we say have the biggest, in the S&P 500, the biggest core earnings edge, or companies whose core earnings exceed their reported earnings or street earnings by the most.
I heard Clorox in there because that chart's been looking pretty darn good. Starting to pick up a little bit, right?
Hey, we're just talking about a beat. I'm not saying it's necessarily the best company in the world. I'm just saying it's going to beat.
Yeah, no, totally. All right, and then I heard Decker's in there, right?
Decker's Outdoor Corp.
Decker's Outdoor, okay. And then there were two more. What else did I miss?
Molina Healthcare.
Molina, M-O-H, I believe, right? Yep. All right, I'm 3 for 3.
And then Biogen. We got 5 on the list total.
Oh, we got, what's Biogen? What is it?
BIIB.
BIIB, that's right. I haven't looked at healthcare in a while. So that's interesting. That chart just pulled back and kind of hit the 50-day moving average like spot on the nose. So that's a pretty interesting setup. You got Clorox for momentum. You got Biogen for pullback, and number 5.
Cisco Corporation, SYY.
Food, SYY, delivery. Wow, breaking out the market. I don't know, David, somebody front running your trades here, man.
Maybe so. Who knows? We've got a lot of different clients.
Yeah, it's a big candle in Cisco. Definitely not front running, sorry, not the other Cisco. BIIB, that one pulled back. So, all right, some interesting setups, some interesting trades. Tell me about, David, how you have taken your research and you have packaged it into something that's an investable instrument ultimately for the ETF tracking the underlying. Because last I spoke to you, you did not have this product. Back at my old gig, we were mostly talking stocks, but I love that you've packaged it into something usable. Tell us about it.
Yeah, I know Bloomberg came to us a few years ago and said, hey, we should create an index around your core earnings number. It's a better number for earnings. And there's papers from Harvard and Ernst & Young and MIT Sloan talking about how the footnotes actually make a difference. It's statistical, it's significant. So we put this thing into an index called the Core Earnings Leaders Index. And as you know, it was up 27% last year, or 50% more than the S&P 500. So I had a great year. And this is a stock picking strategy that's based on AI, Oliver, but it's really simple. It's simple in that all we're doing is identifying a better measure of earnings and picking stocks whose earnings are most understated by the street. So the most misunderstood earnings stories, we're figuring those out. We're going through all the fine print and the footnotes. We're coming up with a better number called core earnings. And when you pick stocks based on that strategy, it tends to do pretty well.
Okay. So what have you had to update in your system with the advent of LLM new technology? Have you been able to thin down your team, do it even easier, David? Has it taken a load off your back? Tell me, because by the way, speaking of carrying weight and taking loads off the back, you sent me over a pretty interesting illustration of what you think this is, which is the evolution of research. So, okay, how do you go from man standing up to combined AI man? Because the way I knew it, you basically were AI the way you were doing your research.
Well, we did have to package it better, and we partnered with Google Cloud to do that. We created an AI agent called FinSights, and I think you're right in your last guest. I think what you guys were talking about in terms of technological innovation and evolution, it's true. So we've seen massive.
Which one? That it's good or bad?
I think it's good. I think there's definitely some good for it, for sure. Like we've used it for good, and I think it can be used for good in ways that most people don't think about because they're always sort of oftentimes self-maximizing for the individual. But in new constructs, we've effectively unlocked the truth that was previously buried in these 200 to 2,000 page filings, and we're making it available at scale.
Okay.
Through this index and ETF as well as through our research.
Okay. Now, how often does it give me a little bit of the secret sauce? What are the numbers that it's spinning? Where are you kind of finding that maybe it adds on to what you were already doing? Like, are you catching different things and go, oh, maybe I would have missed that, or old model, this is now picking up new stuff, or did it more validate that what you were doing was just solid and reliable?
I think the big difference here, Oliver, to your original question, is that we're just able to do a lot more with a lot less people. We've gone through some restructurings, and we have like 80% less people, and we cover more companies and more filings, and we're doing it way faster. So we're able to spend more time on our analytics and other things besides just collecting data. Back in the original days of new constructs, we were covering maybe 1,000 companies, and we spent most of our time all year round parsing the filings. Now the machines are doing 90 plus, 98% of the work, 99, 100% of the work sometimes.
Okay. Tell me about what drove the index over the past year. Were there major highlights? Does it funnel up into sector at all, or were there any notable themes, David?
Yeah, no, this is purposely designed to be a very core type of holding. So it has representation from every sector. It's not growth, it's not value. So it's a very, I would say, diversified approach. It holds 100 stocks. And, we just focus on the top 3 stocks in every sector, are the first 11 holdings, and then the next 67 are the companies that have the biggest core earnings edge and the largest market cap. Okay. And that's it. It's really pretty straightforward. It's passive, so it's automatically rebalanced based on those rules every 3 months. And, I think the numbers speak for themselves. I mean, there must be some alpha in this core earnings number. Otherwise, a very simple passive vehicle like this would not outperform so significantly.
Okay. And it doesn't seem like it's like super duper heavy tech. Like, I'm not buried in tech. This isn't a closet indexer.
No, it's not.
At least not from what I can see.
Yeah, no, I think that's by design. And honestly, one of the first iterations of the idea ended up being a large cap value idea, and we said, no, we don't want to do that. The market's got enough of those. Let's go with something that's core, that's got equal sector representation, so that people can feel like it's a safer bet. And look, I think it's a whole lot safer than any other AI ETF, right? It's not an AI like magical, agentic, whatever. This is just based on somebody doing more diligence on the filings, coming up with a better earnings number, and building a strategy around that.
Okay. I know that the Bloomberg Index is based on your research. You don't run the ETF, but just to kind of close it out, bell just rang. I do want to bring up the ETF real quick for some details. And top holdings, IBM, General Motors, Apple's in there, NVIDIA, Eli Lilly. It is tech heavy, but so is the market, and it seems like different types of tech companies too, notably, and discretionary in there alongside financials as well. Killer year last year, and I'm glad to see you put the research into work and using the AI too, because we got to adapt. We can't just let it run over us, David.
That's right. We're trying to be on the cutting edge of the right kind of AI. This is AI that makes the world a better place.
Amen. Love that. Good to catch up. Thanks for being on the show, David.
Thank you, Oliver. Good to be with you.
You got it. David Traynor, New Constructs. Thanks for tuning in to Chicago Future of Finance. I'll see you tomorrow, same time, 2 p.m. here from the Cboe floor. Have a great night.